Hi students, purpose of this video is to walk you through how to do a statement of cash flow. So before I even start with the cash flow, let me remind you what we're trying to do. We're trying to tell the readers that we started with $300 in cash at the beginning of the year and we ended with $1,000 in cash. So we need to tell them of that change in cash, that increase of $700, where did it come from? So we're going to start with the operating section. And the operating section is unique. It's different than the investing and financing because we have to use a different method called the indirect method. With the indirect method, I have to start with net income. I wish I had the information to tell the reader, here's the cash I got in from sales, or here's the cash that went out for expenses, but I don't. That data is very hard to get to. So that's why FASB allows me to use this indirect method where I start with net income and try to adjust for accrual accounting. So I will start with operating and begin with net income. And the net income from this problem is $1,750. The very next step is to go look at the income statement and say, do I have any depreciation or amortization expense? We know those don't involve cash. For example, when I depreciate assets, I debit depreciation expense and I credit accumulated depreciation. So that expense had lowered my net income, so I'm going to add it back. I'm going to deal with anything involving those assets when I get to the investing section. I'm going to look at the income statement one more time and look for gains or losses. I do see a loss on sale of equipment here. The reason we take it out of the operating section is because we're going to deal with the cash that either flowed in, well, hopefully flowed in since we sold it. We'll deal with the cash when we get to the investing section. So I just want to neutralize the impact of that sale. So I'm going to add back, put 3 Ds in there. Add back the loss on sale. $5. Now from here, I'm going to go up and identify my operating accounts. So accounts receivable, we know is operating. I'm just going to list them all first. Inventory, prepaid expenses, and I'll stop. I won't include equipment and accumulated depreciation because that's investing. That's where we go out and we buy things that we're going to use for a long time. But I'll look at my liability section and pick up any operating liabilities. So accounts payable and taxes payable would be included. So I've got all the accounts. How do I figure out whether to add or subtract? Okay, the shortcut is if it's an asset and increasing, subtract it. If it's a liability and increasing, add it. Right? And do the opposite when it's going down. However, if you're one of the folks that likes to understand the theory, the reason we're increasing when accounts receivable goes up, because accounts receivable is an asset, is because in theory, that means some of the revenue that's included in the net income number, we didn't get in cash. Instead, the debit went into accounts receivable. Whereas if accounts receivable had gone down, we would have received some cash that had to do with prior period sales. So that's an example of the theory, but again, there's nothing wrong with just putting down, if it's an asset going up, subtract it. If it's a liability going down, subtract it. So my accounts receivable is going up, so I'll subtract it. Same with inventory and prepaid expenses. When I get to the liability section, the accounts payable has gone down, so I'm going to subtract that. Because remember, when liabilities go down, we subtract. And the taxes payable went down. All right, I'll sum that up. And this says that, in theory, I brought in $642 from my operations. The next thing you should always do is go to the other information in the problem and see what it's telling you. It tells you sold equipment and received $108 in cash. Okay, now that's giving you really simple information. Normally it doesn't give us this simple. I don't know why this pen is not working. So right away, we can just put in here, we know we got cash from sale of equipment. Sometimes we've had to puzzle that out because we needed to figure out how much had to do with the equipment cost versus accumulated depreciation. But in this case, it actually gives us the cash that came in on the equipment sale. Now what I'm going to do is go to my accounts that I really haven't looked at yet on the balance sheet. So I'm going to draw some T accounts. I'm going to have one for equipment, one for accumulated depreciation, one for long-term debt, one for common stock, and then if it will let me draw one more, one for retained earnings. Now let's see if we know why everything changed. I'm going to start with retained earnings. So retained earnings had a beginning balance of $1,400. Again, always check to make sure you're pulling in the correct year. And an ending balance of $2,950. And we had net income of $1,750. So this doesn't balance right now. $1,400 plus $1,750 does not equal $2,950. We know the only two things that change retained earnings is net income and dividends. So I can assume I paid a $200 dividend. And I'll go up and put that in the financing section. Apologies, I just don't know what's going on with my pen. So the way I'm putting this on paper looks a little wonky. Financing, paid dividend. And then remember, that's a cash outflow because we paid it to our shareholders and we paid $200. Okay, we got retained earnings done. Let's do common stock next. Common stock started with $650 and ended with $700. Well, the only thing that would make it go up is if we issued more and received cash in, because this is actually common stock and paid in capital. That's a financing activity because financing is investors, anything that touches our investors or banks. So we sold shares, and that's an inflow of $50. Okay, excellent. Now we're done with that one. Let's look at long-term debt. Long-term debt started with $300, ended with $400. So we can assume that we borrowed an additional $100. And again, that's financing. So if I borrow money, that's an inflow. If I pay it down, that's an outflow. All right, all that's left is equipment and accumulated depreciation. So let's double check to see if we've taken care of everything in equipment. It started with the beginning balance of $638. It ended with an ending balance of $488. So that, oops, I've got it on the wrong side. So that says that it had a decrease of 150. I'm going to circle that for now because I'm assuming it has to do with the sale, but let's double check. Accumulated depreciation started with 250. We know depreciation expense would have increased it by 27, and it ended with 240. So that means that they would have had to removed accumulated depreciation associated with this sale of, let's add it up, 250 plus 27 minus 240. They would have removed 37 in accumulated depreciation. So let's see if this entry actually makes sense, what they would have done. So they would have debited cash for the 108, they would have debited accumulated depreciation for 37, credited equipment for 150, and a credit, actually it's a debit to the loss of 5. So let's double check ourselves. Does 108 plus 37 plus 5 equal 150? It does. So we know nothing else happened. So that's up, the 108 we have up here is all we need. So we've got a total cash in of 108 from investing, total cash out of 50 from financing. Now don't forget, your very last step is you need to check. And I'm doing this over to the side just because of the way the paper's set up. But remember, I have beginning cash, $300. I brought in $642 from investing. From operations. I brought in 108 when I sold that equipment, and I spent 50 net in financing. And if we've done this all correctly, the sum of these should equal the ending balance in cash, which is $1,000, and it does. So we've explained that net change in cash of $700. Again, if you take the 642 plus the 108 minus the 50, that equals the change of 700. Okay, I hope this helps. Have a good day.